Okay, let's make a start. Good afternoon, everyone. Thank you very much for joining. My name is Brian Burns, and I will be running the session today. I'll introduce myself properly in a minute, but first of all, thank you for joining on what is supposed to be a summer lunchtime, but don't worry, we will brighten up your day with some wonderful investment content over about the next kind of 45 minutes or so. So I hope you've got a cup of coffee, a cup of tea, or your lunch in front of you for today's session. As I say, it will take about 45 minutes or so. Just double checking, everything okay from an IT perspective? Excellent, we're good to go. I'm going to address the main question that we got straight away. The session will be recorded, and a link to the recording will be sent out, hopefully this afternoon, if everything from a tech side of things goes well. So don't worry if you need to drop off early, if you can't stay for the full session. That's not a problem at all. You'll get a recording, hopefully, into your inboxes this afternoon. Thank you very much for the hundreds of questions that we got in advance. They really, really help us to shape the session. You can also use the Q&A function on Zoom to ask any questions as we go along. And if we have time, we may well take some of those questions towards the end. But first of all, who am I and what are we going to cover off today? So my name is Brian Burns. I'm the head of personal finance here at Moneybox. I was a financial advisor for over a decade before joining Moneybox, so advising my customers and clients on all things investing, pension, home buying, and savings. And now I get to do things like this here, which is wonderful. So educating our customers on all things personal finance. And today we're going to be focusing on investing. Having said that, nothing we cover today should be taken as individual financial advice. I think by the nature of the session, that should be relatively clear. But if you do need advice on your individual situation, you should speak with a financial advisor. Based on the nature of the questions that we got in today, we're going to start from the very beginning and discuss what investing is. I find when speaking with customers over the last decade plus and friends and family, people generally think investing is a good idea. They know it's probably something that they should be doing, but often they just don't know how to get started. Investing can mean so many different things to so many different people. So we will start with the very basics today. We'll then ask the question of why do people invest? And then specifically at the moment, the really important question is, why would you invest when you can get a pretty decent interest rate on your cash savings? We'll then look at the year so far in 2024. So how has cash savings and investing performed in the year to date? And then we'll get into the specifics about what you can invest in and how to practically get started, the individual steps that you can take. And then we'll finish off with some Q&A, so some of the pre-submitted questions. And then, as I say, time allowing, we will answer some of the questions that you're currently submitting via the software. So let's crack on. So let's start with the real basics. So if you invest some money, investing is when you buy something and you hope or expect over time the value will increase. It will appreciate in value over time. So let's imagine you've got £100 sat in your bank account today. You can spend that money. You can spend it on things, you can spend it on services or experiences, all perfectly reasonable ways of using the money that's in your bank account. You have that thing or you spend it on an experience and that money is gone. You can also invest that money. And the key thing to take away from today's webinar is that you own something tangible. Most commonly in investing terms, it's called an asset. And you have the opportunity to resell that investment in the future, hopefully for a higher price. So you're buying something today, holding on to it, and hopefully at some point, quite far into the future, you're hoping that you can sell it for a higher price. The list of things that you can invest in is frankly endless. You can hear of people investing in things like wine, fine art, cars, collectibles, all sorts of different things, as I say, completely endless. But more commonly, when people talk about investing, you'll hear about things like the stock market. So people invest in stocks, shares, those words are interchangeable, and there'll be plenty more on those in a minute. There's then more common things as well called like bonds, investing in property, investing in what they call commodities like gold. And then more recently as an investment class, you have cryptocurrency as well. So they're probably some of the the more common types of investments. One of the ones we'll focus on today and spend a good bit of time on is shares, because that is the most common investment when people talk about investing their money. You can purchase investments individually, like buying shares in a company like Amazon, for example, or you can purchase investments collectively in what is known as a fund. And a fund essentially takes investors' money, so multiple different investors, takes their money, pulls it together, and invests it into lots of different stocks and shares, for example, on your behalf. So diversifying your money across multiple different types of investments. So we'll touch on all of that in more detail going on, but the really key thing that I want you to remember from today's webinar is that when you invest in something, you own that asset. So technology has made it incredibly easy to invest, which is absolutely fantastic. Again, we'll talk about the short steps where you can go from not investing at all to having your first investment, and it's very quick and easy. But sometimes when you see numbers on a screen, you see them go up and down, you forget that behind those numbers are real investments and real companies. So if I use that Amazon example again, if you go and buy a share in Amazon today, you own a piece of that company, you own a piece of their assets, you own a piece of their future profits. It's vital to remember that when you invest, you get something tangible back in return. So I want you to remember that today. It's the really key thing to remember, is that you actually own an underlying asset. So investing is buying a tangible asset and hoping that that asset will increase in value over time. Like there being an endless list of things to invest in, there are lots of reasons why people invest as well, and reasons why people should invest. But the main ones that I have seen over the last kind of decade plus are on the screen. And they all have the same theme, and that is trying to grow your money over time. So the first one is actually becoming more important, or has become more important over the last kind of 2 or 3 years, and that's growing your wealth above inflation. Many people try and invest in order to achieve a certain financial goal. So for retirement, for example, a lot of people potentially on the call may not think they're investing, but many people have pensions which tend to be invested and may not realize that they're actually, they are already investors. You can also invest to try and improve your financial security and resilience over time, and often to try and get better returns than on a cash savings account. So cash savings accounts are fairly competitive at the moment, but for the decade before the coronavirus pandemic, you were really getting no returns on your cash savings accounts whatsoever. And many people looked at investing in a way to try and kind of get better returns than they could do in a savings account. One of the things that's specifically not on this screen is investing to get rich quickly. So trying to double your money in a matter of months, for example. So this can happen. It's important to recognize that some people are able to do that, or are fortunate enough to kind of get rich quickly from investing. But somebody making millions on cryptocurrency or an individual stock, for all the people that have done that, there are thousands of people who have lost money trying to do the same thing and get rich quickly. So just like it's completely possible to walk into a casino and put all of your life savings onto a roulette wheel and win, it is possible to get rich quickly, but far more people have lost out when trying to do that. So more wealth and more wealthy people have been created from sensibly investing over time than has been done from trying to get rich quickly. So whenever we talk about investing at Moneybox, it will always mean sensibly investing over time in order to hit your financial goals, rather than trying to invest and get rich very, very quickly. I want to talk about the first example on the screen for a little bit more, because this has become more important in recent years. Inflation, as we know, is the price of things that we buy rising over time. And having been pretty low for a decade, it rose rapidly after the coronavirus pandemic. You don't need me to tell you that. We all know that what £100 bought you in the supermarket 2 years ago does not buy you the same amount of things today. And that's inflation in action. So your savings have got to be keeping pace with inflation, or else what you can use that money for in the future will be going backwards. So that first example that we put up there on the screen, trying to grow your savings and your wealth above inflation, is really important when inflation has been as high as it's been for the last couple of years. Okay. Why would you invest? So that question of cash versus investing. So cash savings accounts are fairly competitive at the moment, but you've probably seen charts like this before, but they are worth focusing on. So this chart shows cash returns versus investing returns over the last 10 years or so. And what if you had started 10 years ago with £1,000? The lower line is what happens if you put that £1,000 into a savings account, and the top line is what happens if you invest that £1,000. Saving into a cash account, you would have ended up with £1,167 after the 10 years. But with investing, you would have ended up with nearly twice as much, so just about £2,200. What I really want you to focus on, though, is the shapes of the lines. So if you look at that cash savings line, you can see it's incredibly smooth. There's just no ups and downs along the way. And that's why cash savings is so appealing, particularly in the short run, because it feels low risk when we talk about inflation. And inflation is the key thing here, because that £1,167 would buy you far less than what it would have done a decade before. Look at the relatively jagged line when it comes to investing. Each up and down can massively play with your emotions. So nobody is pretending that investing is as easy or as smooth a ride as cash savings. Equally, the down periods of investing often capture newspaper headlines, and it can be quite hard to stay the course with investing sometimes. But if you look over a time period like this, over 10 years, you are typically rewarded for sticking with investing versus cash savings. One other minor thing to note, and we'll touch on it a little bit more in a minute, is both of these lines finish at the end of 2023 and don't show 2024, which has actually been a fantastic year for both saving and investing, but more on that a little bit later on. So this kind of hopefully answers the question of why do people look at investing versus cash. Cash can be very appealing in the short run, and it does have a place in everybody's financial plan. But over the long term, and when we talk about long-term investing, we're talking about 5 years plus, investing typically returns greater returns than cash savings. Now, so that I can take a pause for breath and also take a drink, we're going to learn a little bit more about people that are on the line today. So if I can get this technology to work, which I will, a poll should pop up on your screen round about now. So the question is very simple. Do you invest today? And there's a range of kind of 4 or 5 different options there. And I will let that run for a little while. Okay. 600 responses so far, which is brilliant. Still rolling in, so I'll give it another 5 seconds or so. The results will pop up on the screen once I finish, but good to see a lot of people already investing, and good to see some people that are really looking forward to getting started. Only a couple of people that don't intend to invest, which is probably self-explanatory given that you've signed up for an investing webinar on your lunchtime. Okay, let's finish that there. So we've got the most popular result being I've been investing for some time, which is great. Actually equal, just about equal in percentage terms of people saying they've started recently, and then 23% wanting to get started and 4% hoping to get started someday. Excellent. Right, I need to flick on to the second question, and just really for me being a little bit nosy, for those people that haven't started investing, what is the main reason for not investing? And for those of you that are investing already, you can still answer this question if you just think back to before you got started investing. What was the key reason that may have caused you some sort of anxiety or caused you to put off investing for longer than you did? Excellent. Again, up to about 600 answers. Brilliant, and I'll cut that one off there. So the most popular answer on that one, which I may not be able to share, but I can talk you through it. 37% of people said they didn't know how to get started. 27% of people said they're concerned about losing money. Then 19% say they're prioritizing other goals. And then smaller percentages saying that they can't afford to at the moment. So hopefully for those of you saying that you don't know how to get started or concerned about losing money, we should be able to provide a bit more information on how to get started in the rest of this webinar and assuage some of your fears about the riskiness of investing. Okay, so let's have a look at what 2024 has looked like so far, because sometimes when it comes to headlines, as I mentioned before, things like saving and investing only make headline news when things are going badly, frankly, especially the investing markets. If investing markets do have a dip, as they sometimes do, it will tend to make front page news or potentially the headlines, or you may pop up on your social media. When things are going well, it tends to be very quiet. So it's been a great year for savers and investors so far. On the savings side of the equation, over the last 2 or 3 years, we had 14 successive interest rate rises from the Bank of England. This is probably a subject for a different webinar, was then basically trying to get control of inflation. That is the Bank of England's job, and the one tool that they have to control inflation is interest rates. So they raised interest rates 14 times in a row, and the rate now sits at 5.25%. That means for most of us now, you can get above 5% interest on your cash savings for pretty much the first time in a decade. And there's lots of competition in the cash savings market at the moment. So it's a really good time to be a saver. Now that inflation is a little bit more under control, so inflation was running at 11% 18 months ago, it is now running at 2%, which is around about what the Bank of England wanted to be. So now that they have inflation under control, the expectation is that interest rates will fall in the second half of 2024, but they're unlikely to fall quickly, and certainly not down to the sub kind of 1% interest rates we saw for a decade. So there's Bank of England meetings over the next couple of months. We may well see an interest rate cut down to 5%, but it's probably not likely to have a major impact on cash savings rates too much over the course of the next 6 months or so. Probably will remain competitive, certainly compared to the last kind of decade or so. On the investing side, things have been even better. It's been a really strong first half of the year, with the UK stock market up 7%. And the US market up over 16%. We will talk about in a minute how you actually get involved in investing in these things. But much of the gains in the US has come from companies working in the artificial intelligence space, which has captured a huge amount of information. But if you just invest in a diversified fund, which again we'll come on to, that invests in the whole of the US market, or you can even invest in funds that invest in the biggest 10,000 companies all around the world, you don't have to worry about which stocks or sectors are performing well. We just put that up there in case people are interested in that level of information. Now, really key thing to remember, a good financial plan should have both savings and investments. You shouldn't have 1% or you shouldn't have 100% in one or the other. So if you have your short-term money in cash and you've got your long-term money in investments, it's been a really good 2024 so far. But the key question is, how do I decide what to keep in cash versus what to invest? And I really like this question because, unlike a lot of other questions in personal finance or in financial advice, the cash versus investing question actually has a really simple answer, and it's all based on your financial goals. So one of the things that you need to do probably after today's webinar is spend some time thinking about the purpose of your money. If you're fortunate enough where you've worked hard and you've got some money saved in a savings account, what is it there for? It should, most of the time in your life, have a purpose. So a classic purpose for money in a savings account is, that's my emergency fund. That's the money I hope I don't have to touch, but if an emergency arises, I know I've got some money to get my hands on. Another really classic one that we see from our customers is people saving up for a house deposit, which is, again, perfectly valid thing to be keeping money in a savings account for. Or is it potentially for some unknown goal in the future? A lot of people just have money set aside because they know it's the right thing to do, but they're not sure what it's going to be used for in the future. but it is worth spending time working out what your financial goals are. Once you have a decent estimation of your financial goals, everything else in your financial life becomes a lot easier, because you can then assign your different pots towards different saving or investing goals. So we tend to split short-term goals versus long-term goals in 0 to 4 years and then 5 years plus. So anything you think within those financial goals that you're going to use within the next 4 or 5 years, that should be kept as cash. So that's things like your emergency fund, which should never be invested. For most people, their house deposit, if they're saving over that kind of time frame, things like saving up for a holiday or saving up for a wedding, that should all be kept as cash. You should not be taking investment risk with your short-term money. Anything that you think you're probably not going to use over that kind of time frame, then you can think about investing. The reason that we think about it in these terms, and this is what's called your time horizon, so the horizon that your money is going to be saved and invested, is all due to the relative risk of cash versus investing. So if we go back to this chart, you will hopefully see kind of 2/3 of the way along the investing line, you'll see a fairly sharp dip in the green line. And that was the start of the COVID pandemic. When that started in early 2020, there was fairly widespread panic in investment markets because we hadn't seen a pandemic in over 100 years. Nobody really knew what COVID was or how it would impact investments or indeed kind of companies. So if we think back to that example that I used earlier of buying an individual stock in Amazon, for example, basically what people were doing for the first couple of months of 2020 was trying to work out whether, again, from a very kind of myopic view of the world, was this going to be a good thing or a bad thing for Amazon as a company? Everyone being stuck at home, probably a good thing for Amazon, but if goods and packages can't move easily around the world, that's probably a bad thing for Amazon, and it took a while to figure that sort of stuff out. So investment markets dipped heavily in the first 3 months of 2020 during the coronavirus pandemic. What you should also notice about that is, in hindsight, it was pretty short-lived. As it happened, kind of governments reacted very quickly. If you think about here in the UK, we had things like the furlough scheme, which helped prevent kind of mass unemployment. So actually, investment markets recovered quite quickly. But if I go back to that time horizon point, if you had a 5-year time horizon at that point, that blip on the chart just is not an issue for you really at all. It's emotionally difficult, but if you're disciplined enough to stay invested for 5 years, you look back and it's a blip on a chart. If, on the other hand, at the start of 2020, you had a 6 or a 12 or even a 24-month kind of time horizon for your invested money, that would have been quite a major issue at that time. So for your short-term money, you really want the steady line of that cash savings. But for longer-term money, you can weather the ups and downs that are on this chart with the expectation of greater reward at the end. So the two things that you need to think about after this webinar, whether you're invested or not invested: what is the purpose of that account? What is the purpose of that money? What do I hope to use it for in the future? And when do I hope to use it? As I say, if that's shorter than 5 years, you probably should be looking at cash savings. And as mentioned, that's not painful at the moment because you can get 5% fairly easy. If you think, actually, my time horizon is 5 years plus, 10 years, 15 years, this is for retirement, then you can weather those ups and downs of investing. And typically, over the long term, investing has better returns than cash savings. So that's kind of how to think about that split between cash and stocks and shares, because we should both have a little bit of each of those. Okay. Time-wise, looking good. So now we're going to get onto that really practical side of things of how do I get started. And for those of you that said that you're already investing, this is good information as well, because you can cross-reference your current investments, the accounts that you use, the amount that you're depositing with this information as well, and just make sure that you're on the right track. Couple of caveats here. I am only going to talk about the Moneybox process here, which is probably not that surprising when you're on a Moneybox webinar, but I'm not authorized to talk about the processes of other providers. I'm also not going to talk about investing for retirement or investing to buy a house. There are specific products for those. So if you're investing for retirement, you look at things like pensions. If you're saving or investing to buy a house, you typically look at things like lifetime ISAs. But this webinar is going to be kind of long enough without going into those use cases. So we're going to talk about investing some of that long-term money for a goal in, let's say, 7 years into the future. So well over that kind of 5-year barometer. So it may be something like you want to travel, maybe you want to move house, maybe it could be something completely random like setting up a rescue shelter for cats and dogs. That could be for some people, could be absolutely anything. But the first thing that you need to do when you are starting to invest is choose what account to use. And there are two main ones when it comes to investing, and you can see the two of them on the screen there. You've got a stocks and shares ISA and a general investment account. There does seem to be quite a lot of confusion in the UK about what an ISA is sometimes. The ISA itself doesn't do anything other than protect you from paying unnecessary tax on your gains, your returns, your interest in the future. It is a tax wrapper, and it just makes sure that anything that you put into an ISA, no matter how much it grows over time, you don't have to pay tax on that growth in the future. You have a choice with an ISA, which we'll come on to again in a minute. The main choice is between stocks and shares ISA and cash ISA. As the name suggests, that's just what is within that ISA. All the ISA does is protect you from paying unnecessary tax in the future. You get a £20,000 allowance, which you can split across different types of ISAs. Within Moneybox, you get access to the full investment offering, which again, we'll talk about in a little bit about what stocks, funds, and other options you can invest in. But any gains that you make are tax-free. The stocks, the ISA allowance that we are given in the UK, talking geographically around the world, is incredibly generous. There are no kind of additional fees for using a ISA rather than another type of account. So it really is a kind of freebie by the UK government to get people to save and invest a little bit more. So we always say start with the ISA first, because that will protect you from paying, as I say, unnecessary tax in the future. Really, the only reason that you would then move on and use a general investment account is if you have already used up your £20,000 ISA allowance. You get that £20,000 ISA allowance every single year. It is reconfirmed in the government's budget on an annual basis, but it's been pretty consistent over the last kind of 5 or 6 years or so. Resets as of the 6th of April. So next April, you'll have another £20,000 ISA allowance to use. So important thing to remember that the ISA is always the first place to kind of get started. And then if you've used up your £20,000 allowance, that's when you would move on to a general investment account. Anything else I needed to say on that one? No. Oh, good. Okay, so the next step is, and let's say that you have chosen the stocks and shares ISA to get started, is to choose an actual investment to put in that ISA. As we mentioned, the ISA is just the wrapper. You then need to choose what you're going to put into the ISA. For many people, this can be the scariest step. But remember what we talked about earlier. When you invest in something, you own it. So your choice at this stage is what would you like to own for the next 5, 7, 10 years? Hopefully for some people, that will make things a little bit scarier. You're buying something to own for the next kind of 5 to 10 years or so. As discussed, you can buy a share in an individual company. And for simplicity here, I'm going to keep talking about Amazon. Plenty of other stocks are available, but I'll keep kind of using that Amazon example throughout. So you can buy an individual share in an individual company. That's absolutely not a problem. What you can also do is the second example that's on the screen, and you can buy what's called units in a fund, and that fund will then invest in multiple companies on your behalf. So, for example, there's a very popular fund that invests in the top 500 shares in the US, which for this example will also include Amazon. The benefit of investing in a fund rather than an individual share is diversification. So you're invested in many things rather than one thing. So let's say, for example, something comes along and impacts Amazon itself as a company. A new competitor might arise, for example. If you're only invested in that one company, then that is a bit of a problem for you. You're very exposed to the individual risks of that individual company. However, if you're invested in a fund, and we talk about that fund that invests in 500 companies across the US, there's a lot less risk to you of anything happening to one individual company. You may even be invested in that new competitor that comes along kind of via that fund. So those are the first two choices, investing in an individual stock and investing in a fund. In the review of 2024 that we talked about, I mentioned that artificial intelligence stocks have done pretty well so far this year. They've captured a lot of people's imagination, and people have been investing in them. For example, and again, this is not financial advice, but I don't personally own any artificial intelligence stocks, but I do have diversified funds that have some AI stocks in them. So if that particular sector does quite well, but if over next year or the next 6 months, the next 12 months, it's a different sector that does particularly well, so tech or transport, whatever it might be, I don't need to worry about trying to pick what that might be in advance, because I've got a diversified fund investing in lots of different types of companies. So both of those are completely valid ways to invest. One of them is just more diversified than the other. Now, the next option at Moneybox is what we call starting options. And these are a collection of multiple funds across a very wide range of different investments. So they're extremely diversified, which is good. You have cautious, balanced, and adventurous options. They're all designed by experts. So if you don't want to choose an individual stock or an individual fund, the starting options are there ready for you to take off the shelf. The important thing to remember with the funds or the starting options is that you are still owning companies at the end of the day. So that's the theme that kind of goes throughout the webinar. If you invest in a stock, obviously you own a bit of that company, but it's the same with the fund as well. If we talk about that US fund, investing in the top 500 companies within the US, you own a very small fraction of those 500 companies as well. And it's the same with the starting options too. So you still own the assets and typically less volatile as they're more diversified across different types of investments. The final step then, and there really is only 3 steps to getting started investing, is how much to invest. And probably this is the one that's a little bit the hardest one to address in a group, because it's probably most reliant on your individual personal kind of financial situation. But generally speaking, you have 2 main options. The first one is you can invest in a lump sum. So if you have some money in your bank account that you think, I don't need this for the short term, it's going to be, I can put this away for 5 or 10 years. You can take whatever it might be, £100, £1,000, £10,000, invest it on one day, keep it invested for as long as you plan to invest over that time horizon. Statistically speaking, this is actually quite a good approach because there are more positive periods in investing markets than negative ones, which is good. However, the issue is you don't know in advance whether the next few months are going to be good or bad for markets. If we look back at that 2020 coronavirus example, if you had invested £10,000 in early 2020, you probably wouldn't feel very positive about investing after 3 or 6 months, because your investment would be down because of all of the things that we discussed earlier. Also, as we saw earlier, that dip was not a major issue over the longer term, but it wouldn't have been a great time to invest a lump sum. You can still invest a lump sum, you just have to be very disciplined and committed to your long-term time horizon. So if you had invested in early 2020, first couple of months would not have been great, but by now would have more than recovered and have grown well past the kind of pre-coronavirus amounts. The other option that you can look at, the second one that you can see on the screen there, is regular investing, which, as the name suggests, involves investing a set amount of money every week or every month. Most often, this is done from people's regular salary. As you can imagine, if you get paid every week or every month, setting some of it aside for your investments is a very sensible idea and a very common thing that people do. You can also split a lump sum into regular payments. So going back to the previous example, if you had £10,000 to invest, you could invest £1,000 a month for 10 months, and that would reduce the risk of investing a large lump sum today. So as I mentioned at the start, this does come down to your personal situation. It's a personal decision, and as long as you're investing for a minimum of 5 years or so, there's really no wrong answer kind of between the two of these. Whether you get started with a lump sum or a regular investment. We'll come on to a case study in a minute, which kind of illustrates that actually a little bit of both is a really good way to go too. One thing I do want to address in this section is a common phrase that I hear a lot, and that basically is, I'll only invest what I can afford to lose. This is probably the right approach if you're trying to get rich quickly. If you are gambling, if you are buying individual stocks and hoping that they're going to double in value over the next week or the next month. That is more akin to gambling than investing, frankly, and that is probably a situation where you should only invest what you can afford to lose. If, however, you're talking about regularly investing into a diversified portfolio of investments, as we've talked about today, that you intend to hold for 5, 10, 15 years, this is investing, and it's a fantastic way to build financial security over the longer term. So rather, if that is your plan, only investing what you can afford to lose, you should be going back to that stage of analyzing your goals, splitting between your short and your long-term money, and then looking at investing that long-term money and trying to grow it over time. Okay, now we're going to move on to an individual case study, kind of talking us through basically those individual steps. And if we use Alice for an example, Alice is 33. Her financial position is pretty good. She earns £45,000 a year. She was lucky enough and saved up hard enough to buy her first house a year ago with her partner. She has already built up an emergency fund, and she's got around about £200 left in her monthly budget that she's wondering kind of what to do with. So she's probably like a lot of people potentially who signed up for today's session. Saw quite a lot of people respond to that question, saying they weren't really sure how to get started, but they knew investing in general was a good thing to do. So the first thing that Alice does is she sits down and she thinks about those financial goals, and she thinks about that time horizon piece. So she has the money she doesn't specifically need for the next kind of 5 years or so. She's not sure what she's going to use this for in the future, which is perfectly valid, but she knows she's probably not going to need it within the next 5 years or so because her short-term goals are covered. She doesn't have an ISA, so she starts there, as we discussed at that point. If you don't have an ISA, it's a great place to get started because everything you make within an ISA is tax-free. Alice hasn't invested before, so she doesn't necessarily at this point feel comfortable or confident choosing an individual stock or a fund to invest in. So she chooses a balanced starting option, which, as we talked about, is a pre-made portfolio that's been designed by experts that is just ready for you to take off the shelf and start investing. She then invests £100 as a lump sum, and she keeps an eye on it for a couple of months. This is a really, really good way of getting started investing. You can invest that lump sum. You don't necessarily have to do anything else immediately, but you can keep an eye on it for a couple of months, see it start to move kind of gradually up and down, and start building your confidence with investing. All the while, you can learn about what is within each fund, what's within that starting option, and just build up your confidence with investing. Once she's feeling a little bit more confident and she's witnessed it going up and down a little bit over the course of a couple of months, she then sets up a regular deposit of that £200 a month of the money that she had kind of left over in her monthly budget. And then she is done. And over the course of however long that might take, and it can be different for different people. For some people, they may be comfortable doing that straight away. For some people, they might build up their confidence over 3 or 6 months. But going from someone who hasn't invested at all the way up to being somebody who hopefully invests for life, it is really as simple as those 3 steps. The last thing that I wanted to touch on before we get on to the Q&A is some research that Moneybox did, and actually that the FCA kind of started back in 2021. So the FCA highlighted that in the UK, 8.6 million people hold over £10,000 investable assets, as they call it, in cash. And half of these potentially could benefit from investing. And then earlier this year, we did some additional research, and we found that 70% of the people in this country still don't invest. 25% of people say one of their major financial regrets in life is not investing. And 31% of people who do invest regret not starting kind of earlier in life. Everyone, when they start investing, is nervous. When I started investing over a decade ago, it was something wasn't particularly confident about, but I was fortunate enough to be a financial advisor and be able to dedicate quite a lot of time to learning about investing in markets and build up confidence reasonably quickly. But it can be scary. When you put your money into a savings account, a cash savings account, you can be pretty sure what it's going to be worth tomorrow. Whereas with investing, there is uncertainty on when you log in tomorrow, is it going to be up a little bit, down a little bit? But as we saw earlier, over the long term, you massively pay the price for the certainty that you get with a cash savings account. As we've talked about as well today, there are ways to massively reduce the risk of investing. Using a diversified portfolio, investing regularly, and investing for the long term will make investing less scary and less risky than you potentially kind of think it is. The fact that you're here today and you've given up your lunch hour to hear about a webinar investing shows that you are interested, which, to be honest, is the first step. If you keep up that level of interest over a period of kind of 6 months and learn as much as you can about the initial steps of investing, it's learning and a habit that will stay with you for life, and one that will make the rest of your life more financially secure. So we need to turn this country from a country of savers into a country of investors. And the fact that nearly 1,000 people are on the line today makes me very optimistic that we can do that. On to the Q&A. As I mentioned, we are going to do about 5 or 6 pre-submitted questions. There was a lot of common themes across the pre-submitted questions, and then, time allowing, I'll try and do some live. We've probably got about 5 minutes or so left. As mentioned, there will be a recording going around this afternoon. Again, a real theme of the questions that came in was a lot of people just saying, how do I get started? And that's why we have focused quite a bit of time on that today. After the question of will the webinar be recorded or not, this is probably the most popular next question. So hopefully we've covered that in sufficient detail during the session to help build up your confidence enough to get started. But really the process is simple as choosing an account, choosing an investment, and choosing an amount. So just like Alice in the case study on the previous screen, make sure you can leave those funds for 5 years, and then you are good to go to get started. So hopefully we've at least built up the confidence of some people on the line to get started investing. Again, this was a really popular question. I think we covered off a lot of it during the session, but it was from Benjamin that says, what is the safest way to invest? Is it in cash savings account or buying stocks and bonds? Cash in the short run is the safest, as we saw on those lines, but you lose out in quite a big way over the long run. Over the long run, investing is actually safer and more consistent than you probably think it is. So it's all about doing the balance of both of them. Good question that came in from Alex. So how do I save and invest at the same time? Should I invest from my savings or split the savings and invest part of it? So probably the by the book answer here is that you should do one and then the other. So you should save for your short-term goals in cash and then switch over to investing once you've hit your short-term goals. Actually, in practice, you can do a little bit of both. So if we go back to that Alice example, and let's say you were saving £200 a month, and you've got quite a few short-term goals to save for. So you want to build up your emergency fund, you want to build up a holiday fund, whatever it might be. There's nothing wrong with saving, say, 90% of your money, of your regular savings goes into a cash account, and then 10% can go into an investing account. So even if it's a pretty small amount, it's a great way to get started. Once you've then built up your cash savings, you can switch that ratio over. So 90% of it is going towards investing, and 10% can be going over towards cash. So you don't have to do one or the other. You can split a little bit towards cash, a little bit towards investing, depending on what your priorities are at that point. But the key thing is working out what your financial goals are. Again, a common type of question that came in, one from Kaz saying, what's the difference between a cash ISA and a stocks and shares ISA? Again, the ISA is just a wrapper. It's just a type of account. The only thing it does is protect you from paying tax. What matters is what you put in it. A cash ISA, as the name suggests, is a cash savings account, and a stocks and shares ISA, you put stocks and shares into the account. So it's what you put in at the accounts. The ISA is just a wrapper that goes around it and protects you from the tax side of things. Question then from Marcella and says, once I have maxed out my stocks and shares ISA allowance, where should I put any remaining money? So if you're in the fortunate position of maxing out your £20,000 ISA allowance, then you can look at that general investment account that we talked about earlier. If you still want to invest and retain access to the funds, you can also look at things like a pension or a lifetime ISA if you're saving for a specific goal like retirement or purchasing a house. So it's basically about looking at different kind of account types once you have maxed out your ISA allowance. Really good question from Daria, which says, how much should I start investing as a beginner? Is there an amount where it's too small, whereby it's not worth it? There is no amount too small to get started. Somewhere like Moneybox allows you to get started investing with £1. Let's say, for example, you can only afford to put in £10 a month into an investing account. That still builds up your investing knowledge. It builds up your confidence. You get through the process of starting investing. So then hopefully in the future, if you've got a bit more to invest, it all looks a little bit less scary. So there is no amount where it's too small that is not worth it, because all during that period, you will be building up your investing knowledge and confidence. Question from Lucy that says the number one tip for investing. I picked out this one because usually in this situation, somebody is looking for a stock tip or what the hottest thing to invest in is at the moment. If you've been listening to the webinar all throughout, you'll know that is not going to happen. You should be basing what you're investing on your personal situation. But the number one tip for investing, and indeed your personal finances as a whole, is just to spend time on your personal finances. Everything to do with saving, investing, your retirement, whatever it might be, is not a one and done scenario. It's not something that you just completely set and forget for forever. There is always something that you can kind of be learning about or tidying up when it comes to your personal finances. So I would always recommend a minimum of 30 minutes a week to spend on your finances. That can be practical things like shopping around for the best cash savings account. It can be doing things like we learned today about starting investing. It can be tracking down your old pensions if you're not sure where they are. And if you've done all of that, it can just be learning a little bit more about investing, saving, retirement, whatever it might be, watching videos, reading blogs about it. You should be spending a minimum of 30 minutes a week on your finances. So sorry if that's not a juicy enough tip for investing, but it is the one that's going to have the most impact over the longer term. And then the last pre-submitted question, when is the best time to sell investments and what is the process of selling? So a really good question from Rowan. We have obviously spent a lot of time today about getting started investing, but of course, at some point, you're going to want to sell down your investments and use them for whatever financial goal it is that you're saving for. The goal of all of this is not to die with a huge amount of money invested and a load of investments. All of this is to facilitate the life that you want to lead, and you should be selling the investments at some point in the future when you've hit your financial goal. You should be consistently reviewing those goals and also your time horizon that we talked about earlier. So if you sit down in 6 months or so and actually think, I actually need this money a little bit sooner than I thought, I might use it in 2 or 3 years for a house deposit, whatever it might be, that will be a good time to move the investments over into cash. So if your goals change or your time horizon changes, that's a good time to potentially sell down your investments and save them into cash. The process, again, talking about it from a Moneybox perspective, you just go into the Moneybox app and you click on the investment you want to sell. The sell process will take a couple of days and then you can withdraw the funds back into your bank account. In total, it should probably take around about a week, but that should be the process once you've hopefully successfully hit your financial goals, invested for a long time and made some money along the way. That is everything, and we've actually run quite a bit over time, so I don't want to take up any more of anybody's lunch hour. I have put my email address up there on the screen. We are really desperate for feedback on these sessions. We have a huge amount of people on the line, which is brilliant, suggests we're doing something well. But if you have any suggestions of topics that you want to cover, if there was anything that was not in today's webinar that you wanted to see, or something that you wanted more time to be spent on, and any questions that came from today's webinar, we've covered quite a lot of detail quite quickly. So my email address is up there on the screen. The last thing that I will say is that you will get a recording of the webinar into your inboxes, hopefully in a couple of hours' time. But thank you all so much for giving up your lunch hour. Hopefully it's been a useful way to spend it. And yes, please, any feedback and questions over to that email address. Thank you very much.